China closed for a few days, COMEX silver price about to drop. While most traders sleep through the holiday, institutional desks are watching something the retail crowd refuses to see. February 16th through 24th, the Shanghai Futures Exchange goes silent. But silence in markets doesn't mean absence. It means migration. Between now and the reopen, liquidity doesn't vanish, it fragments. And fragmented markets don't follow rules, they follow reflexes. The question isn't whether silver drops during the closure window. The question is what happens when 300 million ounces of paper promises meet less than 100 million ounces of registered metal and nobody's watching the door. What comes next isn't prediction, it's pattern recognition. And the pattern is already forming. Welcome to the COMEX Chronicles. If you've traded through a few market cycles, if you remember when information moved slower but meant more, if you prefer signal over noise, then you're in the right place. This isn't entertainment, this is strategic economic briefing. Now, if you value the kind of analysis that doesn't chase headlines but anticipates structure, do something most people forget to do. Subscribe to this channel, not because I ask, but because clarity compounds. And before we continue, tell me in the comments, where are you watching this from? New York, London, Singapore, Mumbai? Because silver doesn't sleep in one time zone, and neither should your awareness. Now, let's examine what's actually happening beneath the narrative. February 16th, 2026. While most of the Western world celebrates a federal holiday, and while China prepares for its spring festival, something unusual is happening in the silver market. Not unusual because it's unprecedented. Unusual because most participants don't understand what they're watching. The Shanghai Futures Exchange, one of the world's largest venues for silver price discovery, has published its holiday schedule, closed from February 16th through February 24th. 9 days. 9 days where a massive slice of global silver trading activity goes offline. And in those 9 days, the narrative begins. Social media fills with predictions. Forums explode with certainty. Traders declare with absolute conviction that Western paper markets will use this window to smash silver prices, shake out weak hands, and then watch the whole thing reverse violently when China returns. It sounds logical. It sounds coordinated. It sounds cinematic. But markets don't run on cinema. They run on structure. And the structure here is more complex than the story being sold. When observers say China is closed, what do they actually mean? They mean the Shanghai Futures Exchange isn't processing new contracts. They mean onshore Chinese participants aren't actively trading silver futures during these specific days. But they don't mean that silver stops trading globally, because silver is not a single market. It's a network. COMEX in New York, the London OTC desks, offshore Asian trading platforms, all remain operational. Price discovery doesn't disappear during a Chinese holiday. It migrates. It shifts from one venue to another, from one time zone to the next, through corridors that don't require public exchange infrastructure. This is where the first layer of misunderstanding enters. Retail traders often think of markets as binary, open or closed, active or dead. But professional participants know that liquidity is fluid. When one pool drains, flow redirects to other pools. The question is never whether trading stops. The question is, how thin does liquidity become? And what happens when fewer participants are absorbing the same order flow? Here's the critical detail most narratives omit. February 16th is also a US federal holiday, President's Day, which means COMEX, the dominant Western silver futures venue, is also closed on the same day China begins its closure. So the story of China goes dark and the West attacks already has a structural problem. Both hemispheres experience reduced participation simultaneously. That doesn't eliminate risk. It changes the nature of the risk. Thin liquidity doesn't create coordinated manipulation. It creates reflex amplification. When fewer traders are active, smaller orders move prices further. Stop losses trigger faster. Volatility expands without needing a villain. This is observable fact, not theory. Historical data from previous Chinese New Year closures shows a consistent pattern. Volatility rises, intraday ranges widen, but the directional outcome varies. Sometimes silver drops sharply and recovers within days. Sometimes it drifts lower and stays heavy for weeks. Sometimes it barely moves at all. The closure itself doesn't determine direction. What determines direction is the positioning that exists before the closure and the catalysts that emerge during it. And this is where seasoned market participants separate themselves from the crowd. They don't trade the calendar, they trade the setup. They ask, where are the weak points in current positioning? They ask, what price levels would trigger cascading reactions? They ask, what narrative will market participants tell themselves if price breaks certain thresholds? Because markets are not mechanical. They are psychological systems, built on layers of leverage, belief, and reaction. When liquidity thins, those layers become visible, and visible fragility invites testing. Professional desks know this. Algorithmic systems know this. Large participants with multi-venue access know exactly how to probe thin markets for structural weakness, not because they're evil, because they're rational. If you can move price with smaller size during a low participation window, and if moving price triggers stop losses that create further movement, and if that movement creates panic that generates even more selling, Then you have a self-reinforcing cascade. No conspiracy required. Just mechanics. Just order flow. Just human behavior under pressure. So when observers see sharp drops during holiday windows and immediately conclude manipulation, they're missing the more mundane reality. Most sharp moves during thin periods are simply crowded trades unwinding in low liquidity. And silver, with its relatively smaller market size compared to gold or crude oil, is especially prone to these dynamics. It doesn't glide, it lurches. It takes stairs up, then tries to jump out windows. And during a 9-day window where a major participant base is offline, those lurches become more pronounced, not because of manipulation, because of mathematics, fewer participants, same volatility inputs, larger price swings. This is the foundation. This is what's actually happening beneath the narrative noise. And understanding this foundation is what separates those who survive volatile periods from those who get shaken out right before reversals. The closure window is real. The liquidity thinning is real. But the story being told about what that means requires examination. There's a number that dominates every silver discussion in February 2026, 100 million ounces. More precisely, slightly less than 100 million ounces of registered silver sitting in COMEX warehouses. This number gets repeated everywhere. Forums, videos, social media threads, all pointing to the same figure. And then the comparison. Open interest in March. COMEX silver contracts represents obligations for approximately 300 million ounces. 300 million ounces of promises, less than 100 million ounces of registered metal. The conclusion, according to the popular narrative, is obvious. The system is about to break. Default is imminent. The squeeze is guaranteed. But this conclusion relies on a fundamental misunderstanding of how futures markets actually function. And that misunderstanding has cost more traders more money than perhaps any other error in commodity markets. So let's dismantle it, piece by piece, starting with what registered actually means. In the COMEX warehouse system, there are two categories of silver, eligible and registered. Eligible silver is metal that meets all contract specifications, sits in an approved vault minimum, but does not have a delivery warrant attached to it. Think of it as metal that could be used for delivery, but isn't currently flagged for that purpose. Registered silver is eligible metal that has had a warrant issued against it. It's ready, right now, to be delivered against a futures contract. The distinction matters enormously. And when someone says registered inventory is dangerously low, what they're actually saying is the amount of metal currently flagged with active warrants is low, but that's not the same as saying there's no metal available, because eligible can become registered when incentives change, when the economics justify it, when spreads widen enough, when someone is willing to pay the cost of issuing warrants and converting metal from one category to another. This conversion happens regularly. It's not rare. It's not emergency protocol. It's standard market mechanics. And this is where the airport analogy becomes useful. Imagine a major airport. Open interest in silver futures is like the total number of tickets sold for flights departing this month. Registered inventory is like the number of seats available on one specific aircraft type at one specific terminal under one specific set of boarding rules. If an analyst compared all tickets sold to seats on one plane, they could make the airport look catastrophically overbooked every single day. But airports don't collapse because most passengers switch flights, rebook, connect through other cities, or cancel entirely. The majority never intended to board that one specific plane. Futures markets work the same way. Delivery is one possible exit from a contract, but it's not the default exit. Most contracts close before expiration. They get offset by an opposing trade, a long position sells, a short position buys back. Net result, no delivery. No metal changes hands, no warehouse involved. This isn't theory, this is verified by exchange data going back decades. Actual delivery rates on most COMEX silver contracts typically range between 1 and 3% of open interest. Not 50%, not 20%, 1 to 3%. Even during periods of extreme tightness, delivery percentages rarely exceed 10%. Why? Because the futures market serves multiple functions beyond physical acquisition. Hedgers use it to lock in prices without taking delivery. Miners sell futures to secure revenue on future production. Manufacturers buy futures to lock costs, then source physical through separate spot channels. Speculators trade price direction with no intention of ever touching metal. Arbitrageurs exploit tiny spreads between venues with zero delivery interest. All of this shows up in open interest, but none of it represents genuine demand for registered warehouse metal. So when observers see 300 million ounces of open interest and panic, they're counting participants who will never stand for delivery. They're mixing speculators with hedgers. They're confusing gross notional exposure with actual physical demand. And this confusion creates the foundation for squeeze narratives that rarely materialize on the predicted timeline. But here's the critical nuance. Just because the extreme version of the squeeze narrative is flawed doesn't mean physical markets don't matter. They matter enormously. Because while most contracts don't deliver, some do, and the metal available for those deliveries is finite. This is where the registered inventory level becomes genuinely significant, not because it proves imminent default, but because it reveals how much buffer exists if delivery demand spikes unexpectedly. And right now, That buffer is historically thin, not unprecedented, but thin enough that any sustained increase in delivery intentions would create visible stress. The question becomes, what would cause delivery intentions to spike? Usually, it's spread relationships. When the spread between spot and future months widens beyond the cost of carry, arbitrage players step in. They buy physical sell futures and capture the spread. That process requires taking delivery. It pulls metal out of registered inventory. And if enough participants see that opportunity simultaneously, registered inventories can drain quickly. This has happened before. March 2020, July 2020. Multiple instances where registered silver dropped below 50 million ounces. Spreads blew out, and the market had to adjust through price rather than default. The system bent. It didn't break, but it bent hard enough. The participants with physical needs paid significantly higher premiums. And this brings up the final piece of the delivery puzzle. Delivery doesn't always mean metal leaves the warehouse. Often, it's a paperwork transaction. Ownership changes. Warrants transfer from one party to another. The bars themselves stay exactly where they are. So observers can see high delivery numbers and simultaneously see vault totals barely move. Conversely, they can see modest delivery counts, but significant withdrawals. Because delivery and withdrawal are two separate actions. Understanding this distinction is what separates informed analysis from emotional reaction. The physical market matters. Registered inventory levels matter, but they don't matter in the simplistic way the viral narratives suggest. They matter as indicators of structural tension, as signals of how much stress the system can absorb before price has to do the adjusting. And right now, heading into a closure window, with registered inventories below 100 million ounces and March contract expiration approaching, the tension is measurable. Not guaranteed to break, but measurable. Something changed in 2025 that most silver traders completely missed. Not a price spike, not a warehouse drama, not a viral social media prediction, a bureaucratic designation. Silver was added to the United States critical minerals list, placed alongside lithium, cobalt, rare earths, and other materials deemed essential for national security and economic competitiveness. For most people, this was invisible, a footnote in a government document. But for those who understand how policy shapes markets over multi-year horizons, this was a signal, not a trigger for immediate action. A signal that the rules of the game are shifting. Because when governments start treating a commodity as strategically critical, volatility doesn't decrease, it amplifies. And the nature of that volatility changes. Let's understand what critical mineral actually means in practice. It doesn't mean confiscation, it doesn't mean price controls, it doesn't mean nationalization. What it does mean is that silver now sits inside a different policy framework. Permitting for new silver mining projects gets viewed through a national security lens. Financing for domestic production may receive government backing or incentives. Supply chain diversification away from foreign sources becomes a stated strategic objective. Trade policy around silver imports and exports can shift based on broader geopolitical considerations. And most importantly, inventory management by both government and industry starts to reflect long-term availability concerns rather than just quarterly optimization. This is not theory. This is observable pattern from previous critical material designations. When the US designated rare earths as critical in the early 2010s, it didn't immediately change prices. But over the following decade, it reshaped mining investment, processing capacity, and supply chain geography. The same dynamic is now beginning with silver, and the timing is not coincidental, because silver's critical designation sits within a much larger transformation, global electrification. The scale of what's being built is difficult to comprehend without seeing the numbers. Data centers are multiplying to support artificial intelligence infrastructure. Energy grids are being rebuilt to handle renewable intermittency and electric vehicle charging. Solar deployment is expanding faster than most forecasts predicted even 2 years ago. Automotive electronics are becoming exponentially more complex with each model generation, and all of this requires copper, vast amounts of copper. Major research institutions, including those advising governments and mining companies, are now publishing supply deficit projections for copper that span decades. Not temporary shortages, structural deficits, where new mine supply cannot keep pace with demand growth, even with aggressive exploration and development. So why does copper matter in a silver analysis? Because copper and silver are not substitutes. They're partners in the same electrical system. Copper moves the power. Silver manages the connections, the switches, the contacts, for the interfaces where reliability is non-negotiable. When grid infrastructure expands, both metals get consumed. When data centers multiply, both metals are embedded in the racks and cooling systems and power distribution. When electric vehicles scale, both metals sit in the battery management systems and charging infrastructure. And here's the critical asymmetry. Copper is a major mining category. Entire operations exist solely to produce copper. Exploration budgets are enormous. New discoveries get developed into large-scale mines. Silver is different. Roughly 70% of silver production comes as a byproduct of copper, lead, zinc, and gold mining. Only 30% comes from primary silver mines, which means silver supply doesn't respond to silver prices the way pure supply-demand theory suggests. A mining company extracts copper because copper economics justify the operation. Silver comes along as a byproduct. If silver prices double, but copper prices stay flat, the mining company doesn't suddenly produce more silver. They produce the same amount of copper, which yields the same amount of byproduct silver. This creates a structural rigidity in silver supply response. And when demand increases across multiple sectors simultaneously, that rigidity becomes a constraint. The United States Geological Survey, in its most recent mineral commodity summary, noted this exact dynamic. Industrial silver consumption remained robust. Investment demand for coins and bars increased, but mine supply growth was minimal. The gap was filled by above-ground inventories. Existing stockpiles built up during previous surplus years are being drawn down, not catastrophically, not in a way that creates immediate crisis, but persistently. Year after year, supply falls slightly short, and inventories decline incrementally. This is the kind of trend that doesn't make headlines until it reaches a breaking point. And breaking points in commodity markets rarely announce themselves in advance. They reveal themselves when demand surges unexpectedly, or when a major supplier goes offline, or when inventory holders decide current prices don't justify releasing metal. Now, layer in the geopolitical dimension. China controls significant portions of global silver refining capacity. China is also the world's largest solar panel manufacturer. China has its own critical materials list and its own strategic reserve policies, and China has demonstrated willingness to use export controls on strategic materials as geopolitical leverage. Rare earths in 2010, gallium and germanium in 2023. The pattern is established. When materials become strategically important, governments assert control. And when governments assert control, markets become less predictable. So the United States designating silver as critical is not happening in isolation. It's happening in a context where supply chain security has become inseparable from national security, where domestic production capacity is viewed as a strategic asset rather than just an economic calculation, where inventory levels carry implications beyond quarterly earnings. This doesn't mean silver prices must go up immediately. It means the framework within which silver trades is shifting from purely market-driven to partially policy-influenced. And policy-influenced markets behave differently. They have floor prices below which domestic production gets supported. They have ceiling prices above which stockpile releases get triggered. They have volatility that spikes around policy announcements and geopolitical tensions. For traders focused only on technical patterns and short-term narratives, this context seems irrelevant. But for participants thinking in multi-year horizons, this context is everything, because the China closure window is a 9-day event. The critical minerals designation is a decade-long structural shift, and while the former creates trading noise, the latter creates investing signal. The question heading into this closure period is not just will silver drop during thin liquidity. The question is, at what price does strategic accumulation begin to overwhelm tactical selling? Because if silver is now recognized as strategically critical, then large participants with long time horizons may view volatility-driven price drops very differently than they did 5 years ago, not as risk, as opportunity. And that shift in buyer composition changes everything. The closure window is here. 9 days where one of the world's largest silver trading venues sits offline. 9 days where liquidity fragments across remaining platforms. 9 days where narratives compete with actual order flow. And in these 9 days, the professionals separate from the crowd, not through prediction, through preparation. Because no one, not the most connected institutional desk, not the most sophisticated algorithmic system, not the most confident social media analyst, knows with certainty what happens next. What they do know is how to read what the market is telling them in real time. And right now, the market is presenting 2 distinct possible paths. Path 1. Price drops sharply during the closure window. Liquidity is thin, stops get triggered, fear spreads through retail platforms, headlines scream that silver is collapsing, forums fill with panic. Late buyers who entered on momentum convince themselves they've been trapped. But then, something shifts. Buying emerges. Not from retail panic, but from participants who were waiting for exactly this moment. Physical buyers who wanted lower entry points, institutional desks rebalancing portfolios, algorithmic systems detecting oversold extremes in low-volume conditions. The selling exhausts itself, because there are only so many weak hands to shake out. And when China reopens on February 24th, the market discovers that physical demand didn't disappear. It was simply waiting. Onshore participants return, spreads tighten, and price recovers sharply. Not because of manipulation being defeated, but because temporary liquidity disruption met underlying structural demand. This path has historical precedent. It happened in early 2023 during the Chinese New Year period. Silver dropped 8% in 3 days on thin volume, then recovered 12% in the following week when normal participation resumed. The traders who sold into the panic locked in losses. The traders who recognized the pattern captured the rebound. Path 2. Price drops during the closure window. But this time, the drop doesn't reverse quickly, it stays heavy. Buyers don't step in aggressively. Volatility remains elevated, but price continues grinding lower even after liquidity normalizes. When China reopens, there's no surge of demand, just hesitant participants. watching to see if the decline continues. This path indicates something different, not just a liquidity event, a repricing of risk. Perhaps the US dollar strengthens significantly on unexpected economic data. Perhaps real yields spike as central banks maintain tighter policy longer than markets expected. Perhaps a growth scare emerges, reducing industrial demand expectations. Perhaps leveraged speculative positions built up during the previous rally are unwinding in a process that takes weeks, not days. In this scenario, the squeeze narrative doesn't die. It gets postponed. The structural tightness in physical markets remains real, but the timing shifts from March 2026 to some undefined future point when conditions align differently. This path also has precedent. Late 2021 into early 2022, silver dropped from $28 to barely above $20 over several months. The physical fundamentals hadn't changed, but macro conditions, specifically rising real yields and a strengthening dollar, outweighed the supply-demand story. Traders who kept buying the dip based purely on physical narratives watched their positions bleed for months. So which path unfolds? Unknown. Unknowable in advance, but not unreadable as it develops. This is where monitoring discipline separates outcomes. First indicator to watch, price behavior on negative catalysts. If silver drops on low volume and thin participation, but buyers appear quickly each time price tests lower levels, that's absorption. That's a market showing that underlying demand exists, even if temporary fear creates volatility. If silver drops and stays offered, if each bounce gets sold, if volume increases on down moves but stays light on rallies, that's distribution. That's a market telling participants it wants lower prices before finding equilibrium. Second indicator, spread relationships. The difference between spot silver and March futures, the difference between March and May contracts, the difference between COMEX and Shanghai prices once China reopens. Spreads reveal stress that headline prices can hide. If nearby contracts trade at significant premiums to deferred months, that signals physical urgency. If spreads compress or even invert the other direction, that signals speculative positioning unwinding without physical demand supporting it. Third indicator, delivery notices. As March contract expiration approaches, the number of delivery notices issued tells you how many participants actually intend to take or make delivery of physical metal. This number almost always comes in far below total open interest. But the trend matters. If delivery notices increase significantly compared to previous months, that confirms physical demand is real and active. If delivery notices stay minimal, that suggests the open interest was primarily speculative, and much of it will simply roll to later months or close without delivery. Fourth indicator, registered inventory movement. Not just the headline number, the velocity of change. Is metal moving from eligible to registered as spreads widen, indicating owners are responding to economic incentives to make metal available? Or is registered inventory declining while eligible stays static, indicating holders are unwilling to convert metal even as spreads widen? The latter scenario is where genuine tightness reveals itself. Fifth indicator, premium structure in physical markets. Retail premiums on coins and small bars often spike during fear or enthusiasm, but these premiums don't necessarily reflect wholesale market conditions. What matters more is premium behavior on large bars, on institutional size lots, on the products that industrial users and major investors actually transact in. If premiums on 1,000-ounce bars start rising persistently, if delivery times extend, if sellers become reluctant even at higher prices, that's a different signal than retail coin shortages. And the final indicator, how China responds when markets reopen. Not the first hour of trading, not the emotional headline reaction, but the sustained behavior over the first 3 to 5 sessions. Do Chinese participants come back and immediately bid prices higher, showing genuine demand was waiting? Or do they return cautiously, watching whether Western markets continue to weaken? The difference reveals whether the closure window was truly creating pent-up demand or whether the narrative was overstated. Now, the practical question, what should market participants actually do with this information? For traders operating on short time frames, the answer is risk management. Define invalidation levels before entering positions. If buying silver on the expectation of a closure window shakeout and reversal, determine in advance what price level proves that thesis wrong. And when that level is hit, exit. Not with hope that it reverses tomorrow, not with conviction that manipulation will eventually fail. Exit because the market provided information that contradicts the thesis. For investors operating on longer time frames, the answer is perspective. Closure window volatility is noise against a multi-year structural story. If the thesis is that silver becomes increasingly critical for electrification and faces supply constraints, then 9-day price swings are irrelevant. What matters is whether the fundamental story remains intact, and whether current prices offer acceptable entry points relative to multi-year outlook. For those holding physical silver, the answer is understanding. Spot prices and retail pricing are connected but not identical. During stress periods, premiums can spike even as spot prices fall. During calm periods, premiums can compress even as spot prices rise. Knowing this prevents panic selling when spot price drops, if the actual cost to replace physical hasn't declined proportionally. But here's the deeper truth that almost no one wants to hear. The market doesn't owe anyone a squeeze. It doesn't owe anyone a crash. It doesn't owe anyone vindication of their narrative. The market simply processes information and adjusts price to balance available supply with current demand at each moment. Sometimes that process is smooth, sometimes it's violent, sometimes it's frustratingly slow, and sometimes it moves in ways that seem to contradict fundamentals for extended periods before eventually aligning. The mistake most participants make is confusing their thesis with market obligation. They believe physical tightness guarantees higher prices on a specific timeline. They believe closure windows automatically create predictable patterns. They believe registered inventory levels force defaults. But belief doesn't move markets. Order flow moves markets. And order flow is the aggregated decisions of thousands of participants, each responding to their own incentives, their own risk limits, their own time horizons, their own information. Sometimes those decisions align to create the moves that narratives predict. Often, they don't. So as this closure window unfolds, as February 16th transitions to February 24th, as liquidity thins and volatility potentially spikes, the question is not whether the popular narrative proves correct. The question is, what is the market actually doing? Not what it should do, not what logic suggests it must do, what it is doing right now. In observable price action, in measurable volume patterns, in documented delivery behavior, in trackable inventory changes. That information is available to anyone willing to watch it objectively, without emotional attachment to being right, without financial commitment to a predetermined outcome, without social pressure to maintain consistency with previous predictions. And for those who can maintain that objectivity, closure windows aren't dangers to fear or opportunities to exploit. They're simply periods of information revelation, moments when the market shows its structure more clearly, because the usual liquidity cushion temporarily thins. The professionals know this. They're not predicting. They're observing. They're measuring. They're adapting. And when February 24th arrives, when Shanghai reopens, when normal participation resumes, they'll have their answer, not from a narrative, from the market itself.